Welcome to the Frostro Deep Dive into Commercial Property webinar. With a background of interest rate rises, inflation and fears of recession, the UK commercial property sector has seen discounts widen to an average of around 33%. Couple this with concerns once again over the long-term viability of open-ended property funds, with many having returned to gating investors and selling assets. There is little surprise investors are looking at the sector with great attention. However, to assuage your worries, we are delighted to welcome Richard Shepherd-Cross and Ed Moore from Custodian REIT to discuss their results, which were released yesterday, as well as the state of health of the UK commercial property sector in general and their outlook for the future. Custodian REIT focuses on smaller lot commercial property units from £2 to £15 million and is highly diversified geographically and by subsector, and trading at around a 22% discount, tighter than its peers. After their presentation, there will be a question and answer session. Please use the center button at the bottom of your screen marked Q&A to submit your written questions at any time during the webinar. I will now hand over to Ed and Richard.
Matt, thank you, and good morning, everyone. I'm just going to pause for a moment on this opening slide, and just to consider what it is that Custodian REIT are setting out to do. We are, as the text suggests, a specialist in regional smaller property, and I think that will be seen as important as we go through these slides in delivering the returns that we hope to deliver to shareholders over the months ahead. We also set out our mission statement, and that is to be the REIT of choice for private and institutional investors seeking, and here's the important bit, high and stable dividends from well-diversified UK real estate. Diversification, really important. Stable dividends, again, really important. And we'll pick those themes up as we go through the slides. So firstly, this is a trading update, and we will look at earnings and net asset value. Net asset value was down 7% in the last quarter, and the market is reacting to the increase in borrowing costs. And it's reacting to it from, in certain sectors, record high valuations. So it's perhaps no surprise that we are seeing a turnaround in net asset value. But share price has more than taken account of this fall. And one of the weakness of net asset value as a measure is that it is backward looking. And one of the strengths of a listed business is that the share price is forward looking. However, I believe that the listed sector, particularly for diversified funds, has been oversold. And as Matt said in his intro, at an average discount of over 30%, I don't think there are many participants in the real estate investment market that are forecasting 30% falls in values. And why is that? Principally because the occupational market is still very healthy, and that's delivered robust earnings through the quarter of 1.4 pence per share, fully covering our dividend of 1.375 pence, so annualized 5.5 pence per share. And those earnings have been supported through asset management and the continuing momentum in the leasing market. We've agreed 23 new lettings in the last 6-7 months, as you can see set out in front of you, securing £2.8 million of additional rent. We're seeing rental growth at rent review, 22% rental increases in aggregate across 2 rent reviews settled in the last quarter. Further and additional accretive asset management, adding £1.2 million to the valuation of those properties. And we've seen opportunities to invest as the market has started to turn, investing £26.5 million at an average net initial yield of 6.8%, which is, of course, fully supportive of those fully covered dividends that are central to our strategy. And we've been able to take profit on 2 sales. Talk a little bit more about those as we go through. I'm going to hand you over to Ed now to talk to you about one of the other great strengths of Custodian REIT, and that is the strength of the balance sheet.
Thanks, Richard. So this slide summarises our position today, so incorporating the 2 disposals made since the end of September that Richard just mentioned, which generated proceeds of around 10.5 million and reduced our LTV to 24.3%, so comfortably in line with our target level of 25%. We have total debt facilities of 190 million, of which only 167 million are drawn. Over the next 6 months, we expect it to be a relatively quiet period for acquisitions, perhaps with some selective disposals, but we'll be concentrating on investing in our existing portfolio, and you can see we have ample facilities to do so. The majority of our drawn debt, so 84% today, is at a fixed rate of interest until at least 2025. And you can see from the graph on the right-hand side of the page that the bulk of that is fixed until either 2028 or 2032, with just our Lloyd's RCF at a variable rate of interest. And that profile has meant our weighted average cost of debt has remained around 3.5% despite the recent base rate rises. And so that compares favourably to a portfolio yield of nearly 6%. Next slide, please, Richard. Moving on from balance sheet resilience to underlining the robustness of earnings. And the graph you can see compares our ongoing charges ratio, so i.e. the cost of running the fund, as the pale blue line towards the bottom, the weighted average cost of debt as the orange line, against the rolling average recurring income or EPRA earnings as the thicker dark blue line. And what you should take from the graph is that, not surprisingly, ongoing charges are rising. That's due to compliance costs, ESG advisory costs, and a general increase in administrative costs, the cost inflation. The cost of debt in orange is also increasing because we still do have an element of debt at variable rate, so 27 million drawn under the RCF as of today. But what you should take this from this graph is that earnings have remained robust despite those pressures. So you can see the dark blue line consistently being above the 1.375 quarterly level of our dividends. So very importantly, meaning that our target dividends remain fully covered. And we believe that's the only way to properly operate an investment company for the long term. The final bullet on the left talks about the core plus strategy and a lower running yield. And it's important to put that in this context, because what we've not done is bought riskier, lower quality assets just to support our yield and maintain that cover. I mean, if anything, we've done the opposite over the last few years and have been improving the quality of the portfolio as we've reinvested the proceeds of opportunistic sales. And I'll hand back to Richard.
So as well as a strong occupational market and a strong balance sheet, Custodian REIT has the benefits of diversification in its investment strategy. And diversification is something that has, to my view, been entirely overlooked by investors who have been laser focused on single asset investment strategies, be it beds, sheds, or meds, which was the vernacular of the last 18 months that seems to have driven investment decisions. And I don't know quite when it was that people decided that minimizing property risk through diversification was an unattractive thing to do. We've stuck strongly to that strategy, and you can see on this slide we've got 165 properties, over 300 tenancies, no single tenant in any one property representing more than 1.5% of the rent roll. And if you look at our top 10 tenants, they represent only 22% of the rent roll, but that is spread across 28 properties. So with diversity of tenant, you of course also get diversity of property, of sector, and of location. And all of that goes to reducing risk. With a strong occupational market, the close asset management of the property portfolio is essential. This image you can see here is a computer-generated image of the office building we have in central Manchester on Fountain Street. And this is what it will look like when we've completed the refurbishment, which is ongoing at the moment. Absolutely trying to pick up very specific market demand that we can see in the office sector. And the aim of asset management is to pick up on the reversionary potential and maximize the value of the properties under our management. And what this chart shows you is from a passing rent of 41.8 million, we have an estimated rental value across the portfolio of 49.4 million. And that reversion, that 7.6 million pound reversion comes, yes, partly from vacant properties which are to let, but you can see sector by sector where that growth is. So despite the extremely strong performance of the industrial sector, there remains latent rental growth in that sector, in the office sector, and in retail warehousing, with the high street retail rents still settling down, but that represents only 7% of the portfolio, so it's not a big swing. Whereas the industrial sector is 50% of the portfolio, 48% of the portfolio. So just to put some numbers around the industrial sector, because it does make up half the portfolio. Average passing rent in our industrial portfolio is about £6.20 a square foot. Our valuer's estimate of the rental value of that portfolio was around £7 a square foot. So you would see straight away the latent rental growth potential of those assets. Yet at £7 a square foot, we are not going to see an increase in the supply of sub 100,000 square foot industrial and logistics buildings in the UK. Why? Because in order to build them, rents need to be somewhere between £8.50 and £10 a square foot. Otherwise, it simply doesn't create sufficient gross development value to make the development worthwhile. So the £6.20 to £7 a square foot rental growth is the beginning of a trend that needs to continue if we're going to see a supply of new assets coming to the market, which are very much in demand. Asset management touches all parts of the building. I touched on vacancy, which has reduced a little bit. So it's just over 10%. But of that 10% vacancy, 25% of that space is currently under offer. So we will see that vacancy reduce as those leases complete. A little over half of it, 54% of that vacant space is, I suppose, what you might refer to as consciously vacant, because we are either refurbishing or redeveloping those buildings. Now, we're not refurbishing and redeveloping those buildings blindly because they're empty and we don't know what else to do with them. We are refurbishing them and or redeveloping them to meet a very specific market demand. So in the case of industrial buildings, good quality, low EPC, that's energy performance certificate rated buildings. For those of you that are really close to property, you'd understand the term BREEAM excellent, and we're redeveloping to that standard. In the refurbishment of our buildings, again, very strong focus on the environmental credentials of the building, very strong focus on what current market demand is. So in the case of offices, and we showed you a CGI of what the reception area in Manchester will look like. The offices that we're refurbishing there are following a trend that is very current, and that occupiers, post-pandemic, understanding the need for hybrid working spaces, understanding the need to not just mandate people back into the office, but create office space that means people want to come back into the office. So office space with high levels of amenity within the building, be that coffee bars, business lounges, yoga studios. Yes, you heard it here. We are putting a yoga studio into a building. EV chargers in the basement, and turnkey offices where the offices are fully fitted, ready for tenants to walk into, but also creating those high amenity offices in areas of high amenity with good transport links in city centres, close to the shops, close to the bars, because you've got to make offices attractive places for people to want to come to and want to work in. Otherwise, they're simply not going to bother and they're going to work remotely. So that's a very focused refurbishment and redevelopment programme. Through the quarter, we have reassessed 11 of our properties from an environmental performance perspective, where we have either done work or where we've worked with the tenants for them to do work to those buildings. And that on average has improved the environmental performance certificate by a margin, 29 points. But that takes the EPC in aggregate across the whole portfolio from a 60 to a 58. And the lower the number, the better. So we're working on that. And you can see in the chart on the bottom, this is a rent bridge that takes you from where we were in March at 40.4 million of rent. You can see we've made some acquisitions, increasing the rent roll. We've taken some profit and made some disposals, reducing the rent roll. We've seen an increase in the estimated rental value, and occupancy has fiddled around a little bit, but not changing wildly, to take it at period end to 42.9 million. Post period end, we sold a shopping centre, more of that later, to see by November 41.8 million. So growing the underlying rent roll of the portfolio, supporting earnings, improving the environmental credentials of the portfolio. This is what will deliver the relatively high income returns from a well-let diversified portfolio, which is our absolute focus. Some examples really bring some of these statistics to life. Yes Electrical, which is as you can see, a high quality industrial unit on the M62 in Yorkshire. Rent review saw a 33% uplift in rent, adding 200,000 to the valuation. Much of that rent increase was expected, but we actually settled ahead of the valuer's estimate of rental value. So a strong and positive result there. With SCS in Livingston, in the central belt of Scotland, you can see a building with a large area of green in front of it. We have agreed a lease renewal with SCS. We have agreed to extend the unit over that grassed area. So stage one will take the rent on the existing units from 221 to 282,000, and on completion of the extension up to 413,000, adding net of cost 1.5 million to the valuation. It's really strong asset management, maximising the existing assets that we already have. We've agreed a new letting in Crewe to 10 Pin Bowling on a 25-year lease. They do still exist, and that has added substantially to the value, adding nearly £1 million to the value of that asset. And we have, perhaps rather unusually, sold a shopping centre at a profit over the price that we paid for it a year ago. Not many can claim that, but this was an asset that we acquired as part of the Drum Income Plus REIT corporate acquisition last year, and we've sold that at a 3.5% profit over the acquisition price. Shopping centres are expensive assets to own. It does still have 8 years left on the lease to Sainsbury's. But as you can imagine, looking at the building, the on costs of managing that building and keeping it wind and watertight. There is a car park on the roof, just to put that into context, we felt didn't justify keeping it. So we were pleased with that sale, and that has helped to bring our LTV down to 24.5% post period end. Just for reference, all of the images you see are properties in the portfolio, and here is a KFC drive-through. This is a sector of the market where we do still see strong rental growth, demand outstripping the supply of modern drive-through units. So I'm going to restate our investment case here, and for anyone who's heard this before, I apologize, but for those that haven't, worth explaining why it is we focus on smaller regional properties. And what we mean by smaller is sub £15 million. So we're not talking about the corner shop or dilapidated, scruffy buildings in backwater locations. These are full up, grown up commercial buildings let to tenants that you would have heard of in strong commercial locations. But at sub £15 million, we find that we have less competition from those investors with a low cost of capital or lower target returns than us, for whom it would be difficult to compete with. We buy in strong local economies, and we don't believe there is any need to sacrifice the quality of the building or the location or the quality of the tenant just because we're buying sub £15 million assets. What it does give us is a greater share of the value in the bricks and mortar and the land, and therefore higher residual values, so higher vacant possession values. The very nature of having a smaller lot strategy is that it requires us to be more widely diversified, and I've touched on why I see benefits in diversification. And the principal reason we focus on smaller regional properties is the income benefits. What this chart is demonstrating is the net initial yield of properties traded in the market with a lot size of sub 10 million, and that's represented in the dark blue line, and greater than 10 million represented by the light blue line. Why 10 million? 10 million is pretty much where where a lot of investors will consider a minimum threshold for size. Our average lot size is about 4.4 million, so it makes for a good and usable data set. You can see that from 2000 to 2010, there was a pretty consistent 75 basis point margin. Let's call that the risk premium for owning the smaller lots. In truth, there's an awful lot of hassle factor, not in fact risk. People simply can't be bothered to own a large number of small lots. It's easier to own a smaller number of larger lots, but let's call it the risk premium. And you can see that from 2010, that risk premium has widened, except is it a risk premium widening? Did those smaller properties become high risk? Did the larger properties become lower risk? Well, if you look at the current market, what actually happened is the larger properties became much higher risk because the prices became saw such extreme growth with, let's take big box logistics, prime yields at 3.25%. They're now at 5%. So the risk you're taking is pricing risk in that case. You're not taking building risk or locational risk, but pricing risk is extreme. And we haven't seen that. We didn't see the yields come in anything like as keenly. But if there was a risk premium of 75 basis points, and through the last 12 years, it's probably averaged 150 basis points plus, I would argue very strongly that we're getting 75 basis points premium for taking no additional risk. And that means that we have a high yielding portfolio for taking no additional risk, and that we can pay a higher dividend for taking no additional risk. And you can see that when you look at real assets. So here are 4 properties that traded within the last 10 months. Now the market's changed a bit since this, but since these deals were done, but the differential will almost certainly remain the same. So you can see in Birmingham and Stafford, 2 smaller buildings, sub 100,000 square foot buildings. If you had bought those 2 buildings, your average initial yield would have been 5%. If you had bought in Ashby de la Zouch and Lichfield, again, 2 good trunk road industrial locations in the Midlands, your average initial yield would have been 3.2%. So you can see in those buildings, 180 basis point margin. Now, there may be those detractors saying, oh, but the smaller buildings are higher risk. But they're not higher risk, because look at the rents. They're actually let off lower rents. So more room for rental growth. Because if you're going to build new buildings, smaller buildings need higher rents, because per square foot they cost more to build than larger buildings. So there should be more room for rental growth in the smaller buildings than the larger. Yet with that greater capacity for rental growth, you're getting a higher initial yield. So that's really key to the Custodian REIT strategy. In terms of diversification, probably not a lot to see here. It's been pretty consistent, but there you can see the split between industrial and logistics, retail warehousing. Really important that that's retail warehousing, not the high street. There is still rental growth in the retail warehouse sector. We got a very clear look of what a fully online retail world would look like through the pandemic, because shops had to close. But the shops that didn't close, that continued to trade, were those retail parks where people could socially distance, but also importantly, where people couldn't really buy things online. So be that the food, discounters, homewares, and of course all this stuff can be bought online, but by and large, it's not such an online world as fashion, for example. I'll pass back to Ed to talk you through our ESG strategy. This is one of our public access electrical vehicle charging points on a retail park that we look after in Winnersh. Ed.
Thanks. It's probably important to say that ESG considerations are really embedded in our property strategy now. Our environmental KPIs have included as an appendix to the slides, so we won't touch on them specifically. But the stretching nature of those targets show that ESG really is an imperative for us, and probably for all of real estate. Last year, we constituted an ESG committee, which has been very active during the year, updating those stretching KPI target and driving the board's strategic vision, which culminated in a decision to upgrade our ESG advisor to JLL last month, who are probably considered best in class for real estate ESG. We're also compliant with the mandatory SECRA and ESOS legislation, and from the little badges on the right, you can see we voluntarily open ourselves up to scrutiny by reporting under the EPRA and GRESB frameworks. On to the next slide, which shows EPC ratings. Thank you. Richard's already touched on the movements we've seen. So over the last 12 months, we've seen the score go from a 63 to a 58. So getting towards the top of that C bracket. But very importantly, removing all of the F and G ratings from the portfolio, and with an action plan in place to address the D and E scores over the next 5 years. And that's really where our work is concentrated, in trying to eliminate those lower scoring sites, either through reassessment or capital expenditure to improve the performance of those portfolios, because as time moves on, the lettability of the lower scoring assets is going to diminish, and with it rents. And we do have a host of other initiatives ongoing, particularly around installation of smart meters and EV charging, which are really starting to have a positive impact on our environmental credentials. But I think in the interest of time, we don't need to discuss that anymore. Richard's got some specific examples.
Yeah. So here's an example of the building that we own in Redditch. You can see it in the top left. It was predominantly a 1960s industrial building that had been extended in the early 90s. And we could have continued to lease it as it was, where rents would have sort of topped out around £5 a square foot. And it was starting to become the sort of space that not many occupiers wanted. So you can see in the center picture, this is what it looks like as of a few weeks ago. So we have leveled the building, and on the two photographs on the right, CGIs of what we are building on the site. It will be a new 60,000 square foot building, 12.5 meter eaves, BREEAM excellent rated, so that's an EPC of an A. Estimated rental value anywhere from £8.25 a square foot to £10 a square foot, and this will be a rare opportunity for the occupational market. There was a shortage of 60,000 square foot space in the market anyway, and an almost absolute shortage of BREEAM excellent rated buildings of that size. So we're expecting to see a £2 million profit on that deal. Other refurbishment that is, again, very EPC focused, a former Pizza Hut unit. That was a drive-to Pizza Hut restaurant. We have created now, as you can see on the right, a drive-through restaurant that we have leased to Tim Hortons. They have rearranged that building rather than knocking it down. So you can see the sort of cladding that goes around the roof just to hide the old Mexican hat shaped roof of the Pizza Hut to create a much more contemporary looking building. EPC has gone from a D to an A. We've doubled the valuation and for a minimal capital expenditure. So outlook, what's important? All the D's are important. Dividend yield, fully covered by earnings, really, really important. That's what's going to drive 75 to 80% of total return. Debt and the strength of the balance sheet means that we are confident that we can weather the storm created by rising interest rates. A defensive strategy. An income-focused strategy is by its very nature defensive, because if we are paying 75 to 80% of return out to investors, then that's return that's in their pockets, and they're not going to see that ebb away as market sentiment swings around. And diversification, really important to mitigate risk. And surprising to me that this has been overlooked in the real estate investment market over the last few years. And actually, if you look at the diversified funds versus the specialist funds, and given that the diversified funds are made up of typically offices, industrial, retail warehousing, those funds that specialize in those three sectors are at lower discounts than the diversified ones that are made up of those three sectors. And that doesn't make any sense to me at all. So I feel that the diversified funds have been oversold, and at the current dividend yield make a pretty attractive entry point into the market, not least because in our case, the share price is forecasting a 22% fall in value, and across the board maybe 30%. It feels like a lot of that downside risk has been taken out. And from our perspective as a manager, all the R's are important. Your rental growth, accessing that latent rental growth of the portfolio through the management of the assets. Real assets, very good security against inflation, and that security comes from rental growth. So this is all quite cyclical, I accept. The refurbishment of the property, of the portfolio, property by property, as and when we have the opportunity, both when we get properties back and also working with tenants to enhance the environmental credentials, asset by asset, and rent, the principal driver of total return, collecting that rent. And I'm glad to say that rent collection levels have largely been, people are no longer reporting rent collection levels because they have returned to normal post-pandemic. So to conclude, the occupational market is strong, assets are well let, and a diversified dividend-focused strategy, we believe, will continue to deliver returns for investors. Any questions?
Brilliant. Thank you both so much. We've got quite a few questions. Could I just remind those attending, at the bottom of your screen, you have a Q&A button. Please submit your questions written via that. A couple on the A to C EPC ratings. What percentage, what proportion of the properties are now A to C EPC rated?
If we go back to this chart, that is you've raised a very good point. We have provided a chart which graphically gives you the answer, but doesn't have the numbers on it. But I can assure you that the graphical representation does represent the percentage. And unless Ed can magic a number out of somewhere, I'm going to have to rely on the graph to answer that question. And I will make a point of updating that to include those percentages in the future.
Yeah, sorry, I don't have that to hand. I've been searching for the last couple of minutes, having seen the question, but I can't quite dig it out. So we'll come back to you.
We can return on that. Thank you. Another question, just wondering whether the managers have seen any signs yet of distressed selling and whether this is more likely to provide opportunities in 2023.
The retail open-ended funds are pretty much anything in those funds are available to be bought. It's not so much in the market as everybody knows that the assets are available. And we acquired, if you'll forgive me flashing through these slides very quickly, we acquired the asset on the front of the presentation, which is a very prime distribution warehouse, about 90,000 square feet in the central belt between Glasgow and Edinburgh, right on the motorway. It's got a very low site density. It's got 48 loading doors, and this is a cold store facility, or the tenant has fitted it out as a cold store for Gist. Gist took part of M&S, so this is M&S's food delivery hub for the whole of Scotland and Northern Ireland. And we acquired that at an initial yield of 5.25% with a reversion to 7%. And had we acquired it 2 months prior, it would have probably been a 4% initial yield. So is that distress? Is that repricing? It was certainly the open-ended fund who was selling it, needing cash. And one of the reasons we were selected one of the 3 people who were trying to buy it is because we did the deal in 10 days. That's how much they needed the cash. So there is distress out there. The problem with a lot of the open-ended funds is they've been here before, and they've been here probably 3 times before in fairly recent memory. And each time they get here, what they have to do is sell the best properties in the fund. So those funds they're not quite such rich pickings as they might once have been. It was interesting to see in the property press that Blackstone are back in the market buying industrial units on a sort of repriced basis. It was reported that there was £1 billion of central London assets sold by the open-ended funds. So when you talk about distress, that's principally where it's coming from. As yet, the increase in debt hasn't led to distressed sales, mostly because people have got short to medium term fixes, which means the price of debt hasn't bitten, but as those refinances start to come through, but it could be 12 to 24 months away, we might see some forced selling, but principally the forced selling at the moment is coming from the open-ended funds.
Brilliant, thank you. What proportion of your company's rental income is covered by inflation-linked leases? And what weighted average inflation increase caps exist across the portfolio?
I don't have that figure to hand, principally because it's not one that I track. The problem with, well, let's start with the benefit of inflation-linked leases. The benefit of inflation-linked leases is even when there's no rental growth, rents will grow by reference to inflation. When there is rental growth, as we have demonstrated, and I will flick forward a couple of slides just to so you can see where that is. So here it is, the 18% rental growth in the portfolio. Well, that's a little bit more than inflation. Well, industrial is probably at or around inflation, office is a little bit behind. So inflation-linked, RPI-linked rent reviews are very good when there is no growth. When there is growth, what they tend to do is restrict rental growth because they're very rarely open RPI-linked reviews. They're normally capped and collared, but certainly capped at around 3%. So 3% RPI-linked rent review is not going to keep pace with inflation. And our view is you're always much better to take your chances in the open market. You know, as we demonstrated, we delivered a 22% increase in the 2 rent reviews that we settled in the last quarter. That's well ahead of inflation. So we would prefer to have our leases with open market rent reviews because one of the other downsides, and here's an example, this you may think this doesn't put us in very good light, but it gives you an example. We have a Tesco Express in the jewellery quarter in central Birmingham. We've owned it for about 10 years, 8 years since IPO. We've had 2 RPI-linked rent reviews in that time, and that's taken the rent from £68,000 to £84,000. We've just renewed that lease, but that property had become over-rented, and the rent has now fallen back. So you always have to, you always get brought back to market rental levels in the end. Now, in this case, you know, the rent's fallen, you know, £15,000. So it's not a big deal. It was a small property. One of the other benefits of diversification. But RPI rent reviews are not as good as their name would suggest they are. Ultimately, you're always going to see market rental growth over the medium to long term, and that's how we run the portfolio.
Brilliant, thank you. We've just got a couple on the ESG advice. Is the ESG advice that you're paying for materially increased your overall sort of cost of running the vehicle? And are you actually seeing that back in subsequent rental increases from ESG improvement?
I think if I take the first bit, Richard, I mean, we are seeing a material increase in costs of ESG compliance and advice. You know, the breadth of both obligations and expected best practice, you know, is growing continually. I think thus far we've tried to pick our way through. So we do have some exemptions. So we've been applying best practice where we think it's proportionate to the business, but where we get snagged by, you know, listing rules in general, we obviously need to comply. I think the move to JLL is making sure that our advice sort of keeps us ahead of the compliance curve and also keeps us ahead of the best practice curve, so we know what's coming down the line. But ultimately, costs have increased across the board, and I suspect will continue to do so as we're under more obligation to publish carbon reduction strategies and looking into the details of the assets.
Yeah, and in terms of rental growth, if we don't keep these properties up to date with environmental standards and up to date with what tenants demand from their properties on environmental standards, we will see limited to no rental growth and increased void periods. If, however, and we have direct experience of this, and pretty much every time we have expended money on a property to improve the environmental credentials, we have seen greater than the cost of doing the works in rental improvements and valuation improvements. So we see the ESG agenda as a real opportunity for shareholders. If we can provide the buildings that tenants are looking for that have reduced running costs and reduced impact on the climate, then those are the buildings that are going to let first, let fastest, and let at the best rents. And ultimately that will all lead to enhanced valuations. So I think it's an imperative that we do this.
Brilliant, thank you. Is there meaningful scope for future extra revenue from solar panels on properties to offset these ESG costs?
That's absolutely one of the things that we are doing. We have a number of buildings where we have installed solar panels and a number more where we're working closely with tenants to install those solar panels. When we install solar panels on the building, we lease the building to the tenant in the usual way. They are fully responsible for the repair and maintenance of that building. But we as the landlord retain the solar panels on the roof, generate electricity from those solar panels, which we then sell to the tenant through what's called a power purchase agreement. And that runs in parallel with the lease, and it commits the tenant to buying the electricity generated from us. They get a slight discount to the retail price of electricity. So that is price changes with an energy price index. So the tenant benefits and we benefit because not only do we have the rental cash flow from the property, but in addition, we have a solar PV cash flow from the building. The forecasts for payback are improving all the time at the moment because of the price of electricity, but somewhere between 5 and 8 years is probably realistic. Some of the forecasts are a bit keener than that, but being a little bit skeptical about the forecasts, I think somewhere between 5 and 8 years. So that's a 12 to 20% return, which is more than we're getting from buying real estate in the market at the moment. So yeah, a good additional cash flow for the fund. And across our portfolio, we've probably got 80 acres of roof on industrial buildings alone. And we haven't covered all of them in solar panels just yet, but we're working on it. And they don't all face south, so maybe divide that by 2. Maybe it's 40 acres.
Matt, just to come back on the question on the EPC, so we've got 72.7% of our EPCs are A to C. In terms of numbers, there's 54 D rated and 20 E rated. So that's where the focus is. We have a specific objective to remove all of the E ratings by 2025 and all of the D ratings by 2027. But I strongly hope that we would achieve that ahead of those target dates.
Brilliant. Thank you for finding those numbers, Ed. Being an owner-operator with direct contact with your tenants, what's the sentiment at the moment? Are there any subsectors which are more bullish about the future and any particularly bearish or struggling?
No, I don't think anyone's sentiment is particularly high at the moment. I think people are feeling pretty beaten up by economic and political uncertainty. That said, as occupiers of real estate, most of them are finding that there isn't a huge oversupply of vacant space, so they're inclined to sit tight and pay more rent when they're asked to. They understand that there is inflation and that they'd expect to see inflation in their property occupancy costs. So I think it's a tough one to answer when everyone is feeling a little bit nervous and uncomfortable. But from what we see as a manager of this portfolio of 165 properties, is that there is pretty good occupational demand when we provide the sort of assets that people want to occupy. And we see it in retail warehousing. There is demand, and new lettings are taking place in that sector. We are delivering, we hope, offices that will absolutely be in the center of a current market demand. There were some very interesting statistics in a webinar that I attended recently on the sub 100,000 square foot industrial sector, which makes up 95% of all industrial buildings across the UK and 56% of floor area. So while it hasn't been in the news, because the exciting bit of the market over the last few years has been the big box logistics sector, it is half the market and shouldn't be overlooked. Vacancy rates are at record lows. A lot of demand has been suppressed simply because there haven't been the modern, well-specified buildings available. So tenants have just battened down the hatches and stayed put. But were those buildings there, the demand, so the webinar said, is there. And one of the stats that I took great comfort from, and it's not my statistics, so this you might take as hearsay, but it was interesting. I heard it firsthand. In the global financial crisis, demand for industrial space fell 29%. If we were to see the same again, demand would still be higher than it was in 2019. That gives you an idea of the scale of occupier demand in the industrial sector. When you then consider in the industrial sector, of all the development that's taken place over the last 3 years, almost none of it, and clearly that's an exaggeration, but you take the point, very little of it has been in the sub 100,000 square foot sector. Why? Because the demand was for the larger buildings. The larger buildings were cheaper to build, faster to let, and therefore developers saw a quicker and larger return on their investment. But what the occupier market has needed is those smaller buildings in regional markets that are simply not available. And we remain very confident that we will have let our development in Redditch before we've completed that building.
Brilliant. How deep is your appetite at present for adding to the portfolio? Are you actively seeking properties or just keeping an eye open for distressed sellers?
I think Ed made the point that we see that it's going to take 6 months before we really get a feel for where the market is, and it might take a little bit more than that for the open-ended funds to unwind. I mean, as they have shrunk over time, they are a less important factor in moving market pricing, but it's still there. So sitting here today, we're not feeling under pressure to invest. We don't think things are going to be more expensive before Easter. And in fact, we think the values might continue to slide. So we're watching and waiting. Again, as Ed's slide demonstrated, we do have undrawn debt facilities we could call upon if we saw an opportunity that was simply too good to ignore. Our MO is to buy when the markets have moved against, and we did this in 2016 following the EU referendum. Another time, all the open-ended funds gated. The market demand seemed to hit a brick wall, but only for 2 months. But in those 2 months, we invested £60 million. And the secret to property investment, or the first thing you must do, is buy well. So we are watching the market very closely. We don't think the time is now. We think the time will come, and we hope to have sufficient firepower when the time comes to take ready advantage of that.
Brilliant, thank you. That's actually come to the end of the questions. So I'd just like to thank you, Richard and Ed, both very much for your time, and for all the listeners on the webinar today and those who asked questions. If you have any follow-up questions, please email distribution@frostroad.com, and look forward to talking to you soon. So thank you again, Ed and Richard.
Thanks very much.
Thanks.